Good morning, everyone, and welcome to today's webinar. My name is Alex Paul from InvestorStream, and I'll be your host today. Today, we have MPower Group CEO, Nathan Wise, who's going to provide us with an update on the progress of the company's Build, Own, Operate rollout following the execution of binding purchase agreements for the first two 5 megawatt renewable energy project sites in New South Wales and Victoria. Following the presentation, Nathan will address any questions you may have, and we will attempt to get through as many questions as time permits. To send through your questions, please send them through via the chat platform in the question pane in the GoToWebinar control panel. You can also email them to me at alex@investorstream.com.au. You can also download a copy of the presentation by navigating to the handouts pane in the control panel. The presentation has also been lodged on the ASX, so you'll be able to access it there as well. And finally, a copy of the webinar will also be available on MPower's social media platforms and website later today. But for now, I'd like to throw it over to Nathan, who's going to kick things off for us. Nathan, the floor is yours.
Good morning, Alex, and thanks to everyone joining us today and showing interest in our company. It's great to have this opportunity to talk about all the progress MPower is making. MPower has set a very clear goal of establishing a portfolio of renewable energy projects across Australia. We're targeting 20 projects of 5 megawatts each, starting with solar PV initially, but importantly, the projects are being designed with the intention of adding battery storage down the track. The solar portfolio will have a value of more than 150 million once constructed, and even more with the addition of battery storage. Alex, if you wouldn't mind just moving to slide 3, please. The portfolio will be geographically spread, with New South Wales and Victoria being our initial focus, and those are the markets where we see the strongest long-term outlook. By keeping the offtake strategy flexible, our portfolio will be very well placed to take advantage of future market opportunities. We see volatility in the market as an opportunity that can be monetized with the right strategy. When we combine the flexible offtake strategy with the benefits of 5 megawatt projects, we see a very compelling investment opportunity that can scale considerably. Next slide, please, Alex. We talk a lot about 5 megawatt projects, and these images on the screen are here to give you a better idea of what a 5 megawatt solar farm looks like. This is the Piri solar farm that MPower designed and constructed in South Australia. Projects of this size typically take up around 10 to 15 hectares of land, utilize around 12,000 solar panels, and have the capacity to power around 1,500 homes. With a capital value of circa $10 million once fully constructed, projects of this size are best described as small-scale utility projects. MPower has successfully delivered 5 projects of this size for our third-party customers, so we know a lot about them, and we're a market leader in this space. Next slide, please, Alex. There are some very real advantages of 5 megawatt projects over larger utility scale projects. We can deliver a 5 megawatt project very quickly from bare land to revenue generating in 9 months. And this will get quicker and quicker as more and more projects are rolled out and efficiencies can be achieved. Our projects are low risk in that the connection process is relatively simple and the projects are eligible for a standing exemption under the market rules. Importantly, there's also no curtailment risk or exposure to ancillary service charges, which could otherwise have a significant and negative impact on the project economics. 5 megawatt projects are financially attractive with minimal fees and charges and the ability to generate revenue quickly due to the relatively short construction phase. There are also significant benefits of combining multiple projects together in a portfolio to provide weather diversification, network diversification, and ensure there's no single point of failure. Next slide, please. We're targeting our energy on areas that are core to our competency and where we can add the most value. What that means in practice is that we focus on our experience in designing and constructing power projects and looking after those projects over their lifetime, which in the case of renewable energy projects is 30 years or longer. We prefer to leave the developing activities to others, so we've teamed up with a number of project developers that we know from our EPC experience. With this model, the developer takes the risk during the development phase, and we look to enter exclusive arrangements with them to provide line of sight over the pipeline. We currently have exclusivity over 10 projects, and we're looking to expand that over time. When a project is sufficiently progressed, we enter into a purchase agreement with the developer with the aim of acquiring the project when it gets to shovel-ready stage. And that's where we're up to with our first 2 projects. So let's have a look at them. Next slide, please, Alex. We announced on Tuesday that we've entered into purchase agreements to acquire our first 2 build, own, operate projects with a total purchase price of approximately $1.3 million for both projects. The first project is the Narromine renewable energy project, which has been developed by ITP Renewables and is located approximately 40 kilometres west of Dubbo. The second project is the Mangalore renewable energy project, developed by Tetris Energy and located 120 kilometres north of Melbourne. Our approach is to aim for high quality and high reliability projects that will generate clean energy on a reliable and consistent basis. We selected these particular projects because they're located in growth areas and the sites themselves are highly compatible with renewable energy activities. We've been working with both developers for some time, and we hope to successfully acquire more projects from them and other developers in due course. Next slide, please. The Narromine project is a 5 megawatt project that's being designed by MPower utilizing our preferred technology. Bifacial PV modules have been selected, which enables the solar power to be produced from both sides of the panel. We've sized the DC capacity at 6.7 megawatts to optimize the project economics. In simple terms, this refers to the collective capacity of the solar panels at their peak output. The single axis tracker system allows the solar modules to track the movement of the sun on a single axis during the course of the day. This increases the amount of energy that can be produced by the farm. Incorporating a central inverter in the project design is not only efficient, but is also a nod to the future to enable DC coupled energy storage to be added later without requiring a redesign of the project. We estimate the Narromine project will produce more than 14,000 megawatt hours in its first year of operations, which is towards the higher end of what we'd expect from a project of this size. And the project area of 13.7 hectares gives you a good sense of the physical size of the project itself. Next slide, please, Alex. Turning now to Mangalore, the 2 projects have many elements in common, which is intentional and reflects our aspiration to standardize as many aspects of the project as possible to lower construction and operating costs and extract efficiencies wherever we can. Like the Narromine project, Mangalore has been designed to incorporate bifacial PV modules, a single axis tracker, and a central inverter system. You'll see the DC sizing at 6.3 megawatts is smaller than Narromine, which is also reflected in the expected energy production of 10,500 megawatt hours in the first year. Essentially, each project is designed to take into account the specific site and connection conditions. It's these types of challenges that our design team is particularly well equipped to tackle. The estimated carbon offset at almost 8,000 tonnes has been included, so you can see the significant positive impact each project will have. Next slide, please. There are 3 key things that we need before a project achieves shovel-ready status. First, land rights, usually in the form of a long-term lease. Second, planning approvals from the relevant planning authority. And third, approval to connect to the grid. All of our projects connect at the distribution level, which is much simpler than the process that large-scale projects have to go through. Land rights and planning approval for Narromine have already been obtained, and the connection approval process is well advanced. For Mangalore, land rights have been obtained, an application for planning approval has been submitted, and the connection approval is in process. In terms of timing, the Narromine project is expected to be shovel ready in the next 3 months and revenue generating early next financial year, following completion of the construction period. The Mangalore project is expected to be shovel ready soon after Narromine in the December quarter, and the project is on schedule to be revenue generating in the first half of next financial year. Next slide, please. I'd now like to step through the financial metrics around the two projects and explain why they're such a compelling asset class. This slide sets out the high-level project metrics in the top section and the metrics as they apply to MPower in the bottom section. In the future, when the projects are shovel ready and we release details of the funding model, the way in which MPower is leveraged into the projects will be clearer to see. The project values of $10 million for Narromine and $9 million for Mangalore are made up of the development and establishment costs, together with the cost of designing and constructing the projects. They each have an expected life of more than 30 years, and you can see the gross revenues for each project over that period being more than $30 million. Project revenues are driven principally by the spot market under our merchant strategy, so variability is expected over the life of the assets. We're targeting returns of 8 to 10% on a pre-tax geared basis, and the project payback period is 12 years. MPower earns the upfront revenue from constructing the projects, and we've assumed a gross margin of 20%. We will also be managing the assets and undertaking maintenance services, which creates a long-term income stream that will build up over time as the number of projects under our management increases. Finally, our share of the project returns will be driven by the funding structure that's ultimately put in place. Each funding alternative has different risk and reward characteristics, and it's important to get the balance right for all parties. Next slide, please, Alex. During the last financial year, we focused on building a pipeline of project opportunities and securing exclusivity to the projects that meet our investment criteria. At the end of the financial year, we had exclusivity over 10 projects, and we're continuously running the ruler over new project opportunities. Our goal for the first quarter of this financial year was to secure purchase agreements for the first projects, which we've now done, and we'll look to commit to additional projects in the same way moving forward when they're sufficiently progressed. Our next immediate target is to lock in funding arrangements, which will enable us to commence project construction on the initial assets. As the timeline shows, the operating phase will kickstart next financial year when the first assets are revenue generating. Next slide, please, Alex. There are a number of elements to our business model, and they all work together in parallel. We've included this dashboard to give you a simple snapshot of where the business is at and the targets we're working towards. Over time, the megawatts will start moving across the boxes to the right as we commit to further projects and go through the construction phase. We're targeting 25 megawatts under construction, which equates to 5 projects at various stages at any one time. You can also see our target of 100 megawatts in operational assets in the bottom right corner. We'll be updating the dashboard as we execute each step of the strategy. Next slide, please. In summary, we've made a lot of progress in recent times to expand our build, own, operate activities. The pipeline is ahead of where we expected it to be, and we're happy with the spread of project opportunities across New South Wales, Victoria, and South Australia. The purchase agreements that we entered into this week are a big milestone for the company, and the first 2 projects that we've talked about today are high quality assets that will perform well over the medium to long term. In the background, we've been busy establishing all the internal systems needed to efficiently deliver multiple projects in parallel and drive down project costs. And we expect to see the returns on that work as the business scales up. Now that there's greater clarity and visibility on the first projects and the future pipeline, we're well positioned to progress various funding options that we've been discussing with potential funding partners. And we look forward to sharing that with you at the right time. Next slide, please. Actually, 2 slides to finish off with some brief corporate information. We've had some changes to the board and recently welcomed Amy Keane as a non-executive director. Amy is a highly capable renewable energy expert who understands where we're heading, and we look forward to her contribution on the board. Our capital structure is relatively tight, with 218 million shares on issue and a market cap currently around 16 million. Our top 20 shareholders hold 61%, including my family as the largest shareholder at 35%. That's the end of the formal presentation, so back to you, Alex.
Thanks, Nathan. We have had a couple of questions that have come through, and please feel free to continue to put those questions through to us through the questions panel or email them to me. But the first question, Nathan, can you just please expand on the reference to the $150 million portfolio for 20 sites reference? And can you talk us through what's the attributable cost to MPR at a head CEO level?
Sure. So the reference to $150 million is a minimum value that we see for the 20 projects in the portfolio that we're targeting. In reality, we expect that number to be somewhere between 150 to 200 million, as each project has roughly a value of between $8 and $10 million. Of that, in terms of what's attributable to MPower, the lion's share of it relates to the cost of designing and constructing the projects. And you can see from the financial metrics included in the presentation that that can be anywhere between $7 and $9 million for a project. So that's the value add, if you like, that comes from MPower being the EPC party on these projects.
Thanks, Nathan. What's the market value of that fully built portfolio in terms of power or CF generation? And should we look at industry sales averages based on recently reported M&A for solar portfolios?
So the market value of operating renewable energy projects is something that goes up and down, particularly in the case of the strategy that we've embarked upon, which is a merchant strategy where we don't look to lock in the offtake, we look to take advantage of volatility in the market. So we expect the value of these projects to have some variability in them over the course of their 30+ year life. And we have seen some market examples recently of solar farms being transacted. They have generally been projects with a contracted offtake and at the larger end of the spectrum, so large scale utility projects. There's not a ready market yet in Australia for projects of this size, and in many ways we're leading the pack on that. So it's part of our strategy to take advantage of the movements in asset values over time, which is really a reflection of what's happening in the energy market.
Thanks, Nathan. Now, I just want to clarify, and correct me if I'm wrong, Nathan, but all the excuse me, all the currencies that you've been using in this presentation are in Australian dollars. That's correct?
That's correct.
That's fine. Thank you. We just had a question come through. Just wanted to clarify that. So what's the estimated revenue per 5 megawatt farm on an annualized basis with cost of goods sold?
So that's a good question, Alex. We included in the presentation the expected revenue for the projects over a 30-year life, which is around 31 million for Mangalore and around 37 million for Narromine. So that gives you a sense of the scale of operations and revenue that we're looking at for projects of this kind. To also put it in context, we've looked at the energy market and revenue streams going back 12 months for projects like these two. And if you take Narromine as an example, if Narromine had been operating for the last 12 months, the total revenue for that project from selling electricity and from the renewable energy certificates it would have generated would have been north of $1 million and close to 1.1 million. So the revenue stream is quite significant, and remembering as well that there's no input cost, yeah, the return profiles can look very attractive for this asset class.
Can you just, you recently announced $1.3 million in payments for 2 binding sites this week. Can you just expand on your progress for funding?
Sure. So we're talking to a number of parties around the best way to structure the funding arrangements for the first 2 projects and for the projects that are in our pipeline that will follow the first 2. It's too early for us to share details of that with the market, but we will certainly do so at the right time. The core principles for us are firstly to keep the ownership of the underlying assets separate from ownership of the MPower operating business. We think they're 2 very different investment propositions. And secondly, to make sure that the capital utilised for this build out is the most appropriate capital available and can be optimised over time. So that's how we're approaching it, and we will be making further announcements about funding at the right time.
Thanks, Nathan. Can you just explain your reimbursement for passing the projects through to the SPV and reevaluation of those assets and options?
Sure. So, yeah, our model is to acquire these development projects and then to arrange the funding for them and to package up the opportunity. So as part of that, we do add value, both in terms of the assessment of the opportunities, the due diligence, the funding and structuring capabilities that we have in-house, and being able to present those to potential funding partners. So there is a value add in that, and for that value add, we do expect to have, you know, our share of that value creation attributed to the MPower head company.
So how many additional sites does MPower retain exclusivity over at the current time? And are these sites spread across different states, or is it only for Victoria and New South Wales?
So in addition to the 2 that we've been talking about today, we've got exclusivity over a further 8 sites, and they are located in Victoria and South Australia. So there's a spread of projects there.
And when do you expect to execute additional purchase agreements on other sites?
So this is a rolling strategy, and of the 8 that we have under exclusivity, they're all at different stages, and we expect each of them in due course, providing the development meets our investment criteria, to progress towards purchase agreements and ultimately to be acquired and constructed and operated. So we think that purchasing sites like this that we've announced this week will become a fairly regular occurrence for us, and needs to happen 20 times for us to reach our target of 20 projects.
Now, you mentioned something just before in terms of the criteria. Can you just walk us through the criteria that the company uses to assess selecting sites?
Sure. So the first criteria, and the thing that is, I guess, a bit of a gateway when we assess projects, is its location. And that's important primarily depending on where it is on the grid, and we look for projects that are in areas of the grid with good transmission capability, in areas that have got strong growth and where the project economics are going to stack up best. So there's an element of where it sits on the grid. There's also the irradiance levels that are important in terms of predicting future revenue. And then there are some more local criteria, which are things like the ground conditions, the attitudes of the local communities, access to the site, and those sorts of things. So we've developed quite an extensive checklist and process for assessing sites and being able to sort of weed out the ones which we think are going to be high quality and high performers versus ones which don't have those same characteristics and will ultimately not have a quality revenue stream that meets the criteria that we've set.
So Nathan, in terms of the 5 megawatt projects you are planning on developing, can you benchmark the return on investment based on the returns of other solar farms that are operating in Australia?
So 5 megawatt solar farms are highly competitive with other solar farms of a larger scale. We set out looking for opportunities in the renewable energy sector that provided both interesting and quality revenue streams, but also with a risk profile that we think is acceptable and is minimized wherever possible. And so when we compare what a portfolio of 5 megawatt projects can provide to an investor, both in terms of risk and return, and we put that up against larger scale solar, where there may be a lower cost of construction given the scale, but there's also some significantly higher risks in those revenue streams, and they come in the forms of the risk around connection and delays that can happen in that respect, and also in the operating phase for the projects, where the market operator can, without notice, curtail the output from solar farms depending on what's happening in the grid. Those sorts of risks are really not present in the 5 megawatt market. And so we think when you look at it on a risk reward basis, they are very compelling. And the portfolio approach of having multiple projects together, each with a lower risk profile, just sort of supercharges the that protection against downside risk.
So Nathan, given the build, own, operate strategy seems to be the company's focus now, are you still pursuing third-party EPC work?
We are, Alex. So we think doing EPC work for third parties is an important revenue stream for us, and we learn a lot through those projects, and it helps ensure that we remain competitive and at the leading edge in terms of technology. And so that's certainly an aspect of our business that continues. Our focus is more and more on our build and operate projects, but we come from an EPC background, and we see the benefits of staying in that. And that also is important to where we're going as a group.
And excuse me, is the board giving any consideration to growing your maintenance operations, given you have capability in the renewable sector?
Oh, absolutely, Alex. So we've got a very good and quality maintenance business that looks after hundreds of power systems, and we see the value in that recurring revenue stream, and it's a capability that we have in-house, which is incredibly relevant and compatible with what's happening in the renewable energy sector. So we're very much focused and looking to grow that maintenance operation and provide that recurring revenue stream as another base for the business.
Excuse me, Nathan. So you mentioned the recurring revenue stream there. Now, in the presentation, you mentioned an internal rate of return of 8% to 10%, and you also mentioned that you intend to take advantage of the volatility to increase your revenue stream. Is it your intention to add batteries quickly to enable you to participate in the various frequency control ancillary services markets, or will the arrangement be purely merchant, targeting the national electricity spot market for some time?
So initially, it's a solar PV strategy, but as I've said during the presentation and previously, we're doing this with the intention of adding battery storage down the track. The time at which we do that is when the addition of battery storage will enhance the project returns. And that can be done in a number of ways, but principally will be from time shifting the export of power, which in a solar alone scenario happens during the day, but with the addition of batteries allows you to export the power generated later in the day or at night when power pricing might be more in your favor. So batteries are at the core of our strategy and will enable us to further take advantage of some of the volatility that we see in the market. And we're watching that very closely, and we're continuously staying abreast of all the technology changes happening in the battery space. And we are moving towards a position where the battery case, the business case of battery stacks up and we're able to implement them. But in the first instance, it'll be a pure solar scenario.
What is MPower's sustainability plan to reduce carbon emissions from solar farms emitting heat into the atmosphere through reflection?
Well, I think when you're looking at renewable energy assets, you have to look at their sort of net impact on the environment. And you can see from the numbers in the portfolio, in the presentation, that there are between 8,000 and 10,000 tonnes of CO2 emissions that are offset from these projects. So there's going to be, I guess, impacts in terms of construction, manufacturing, and operations on the environment, but that carbon offset is significant, and I think outweighs any other impact that the projects have on the environment.
Bit of a broader one for you, Nathan. In your opinion, is there a market for smaller community-focused projects that are less than 5 megawatts? And if so, have you considered pursuing those smaller projects?
Look, I think there is a market for community-based projects. I think it's important that that size is kept in mind. We've seen quite a number of community-based projects at the 1 to 2 megawatt level, which is very difficult to make work from a financial and economic perspective. We're focused on projects where we can control as many aspects of the project as possible to minimize the cost, increase standardization, and increase project returns, and enable us to scale and roll out a portfolio as quickly as possible. One of the challenges with community-based projects is that there's lots of stakeholders involved, and often the timeframes involved are quite extended. So we will most likely be involved in that sector through our EPC division, and we do offer our EPC services to community-based solar projects.
Thanks, Nathan. A couple more to finish off, and then we'll let you go. What is the merchant energy cost assumption that you've used for the investment model?
So that's a good question. And just for background, because it's a merchant strategy and we take the price on the day, a very important aspect of predicting the returns of these projects is what will the power price be every day for the next 30 years. And of course, that is something which no one can say with certainty. We use sort of third-party forecasts and estimates to help guide the financial modelling that we do for projects like this, and apply, I guess, sort of market standard inflation and other factors to those numbers. We we're like everybody else in this market. We do what we can to forecast and predict. But I think the most important aspect from our point of view is to not just look at the absolute price, but to look at the variability and volatility in the price, which is where a lot of the opportunity is, particularly for smaller and distributed solar farms, where you can react quickly to changes in the market and where you've got exposure to multiple price pools in the market. So whereas one large scale utility project is only in one place and in one market, in our portfolio, we can be playing in different markets at the same time and in parallel. So I'm not sure if that's answered the question directly, but it's given you a little bit of context of how we approach that forward revenue assumption.
Thanks, Nathan. What historical information is available to support the recurring cost of ongoing maintenance of sites?
Look, there's a fairly well-established market for the cost of O&M on projects like this, and that's generally not a large part of when you look at it compared to the revenue that the solar farms can produce, but is obviously an important part. The other factor which is often overlooked is the service levels that come with that. And we know through our experience in multiple 5 megawatt solar farms that ensuring the solar farms are up and running and producing power and selling the power to generate revenue is a lot more important than trying to get the lowest possible O&M cost, because if the solar farms aren't operating, then you can't earn the revenue, and it actually is more important to focus on that side. But we're lucky we've got that capability in-house, and so that's something that we're very experienced in.
How many sites do you need to have running for the company to be break even?
Well, look, we've shown, if you look back over the last 18 months or so, that with as little as 2 or 3 projects, we can have positive EBITDA. And we think that as the number of projects grows and we can bring the costs down and get more efficiency out of it, that will only improve.
Nathan, are there any risks to your construction timetable due to the current COVID lockdown? And if, I guess, extended to that, any risks in terms of access to the construction resources with the restricted intrastate movement?
Look, the COVID restrictions are something that are impacting every business. We are lucky in that we've got good subcontractors and partners that we work with in different states and different territories. So we've got quite a deep bench that we can draw on for resources, so that we're not totally reliant on being able to move people across borders in order to deliver projects. That said, we are cognizant of the fact that there can be delays in procuring materials from overseas due to COVID. There can be delays in when lockdowns impact your ability for things like the construction industry to be able to go about its business. And we've also got the experience in the last 12 months or so of being able to successfully deliver solar projects in another state, in South Australia, during successive lockdowns, and we've done that quite successfully. So there are some risks there, but we think they're manageable, and there is some allowance in our programming and scheduling to take into account things like that. But it is a little bit unpredictable, and we look at it every day to make sure that we're doing everything we can to minimise the impact.
Thanks, Nathan. Only a couple more to go. You've been, as always, thank you very much for your time. But 3 more. When do you plan to finalise your SPV?
So if you have a look at the timeline that we included in our presentation today, we're looking to have project funding locked in before the end of this calendar year, and that's so we can get going with the first projects, and that's the schedule that we're tracking against.
And what are the, just broadly speaking, Nathan, what are the barriers to entry for your industry?
So the barriers to entry in some respects are quite high. Our business is built on a technical and engineering capability, and without that, it's very easy to either make mistakes or to misunderstand the nature of these sorts of projects and the financial implications of that. So having that capability is important. Having the track record of successfully delivering projects and understanding the elements that go into each of these projects and the risk points is vital to a successful project. So to a party that's never been involved in a 5 megawatt project and may have only focused on rooftop solar or other types of solar projects, it's quite a different style of project, and some of the technical challenges are quite significant. And I think the other thing that assists is that the more projects you do and the more scale you have, the better the buying power, the better your relationships with subcontractors, and your ability to de-risk both the delivery of the project and the operational aspects of it is greatly enhanced. And so we are a leader in this area of the market, and we do have competitors, but we think that we measure up very well against them.
Thanks, Nathan. Final question from me. Will all of the future sites be solar, or will sites include other options such as wind power, where a site is highly suitable to that sort of source of generation?
Yeah, so the 5 megawatt market is really around the 5 megawatt connection, and that's like a license to play in the national market. Our strategy is to stick to solar PV initially, to add battery storage next, but where it goes from there during the long life of these projects, it's hard to say. And you can plug any number of technologies into that 5 megawatt connection point. We don't see wind being in our immediate future, mostly because we don't have the experience in it, and we think that most successful wind projects are larger in scale, and the nature of the infrastructure is different there. But I can absolutely see the day where a solar and battery hybrid project is further augmented with a a future technology to enhance the project returns, and we're always on the lookout for what's emerging in that space.
Thanks, Nathan. Look, that's all the time we have today, but thank you all for joining me. And I'd also like to thank Nathan for presenting and taking the time to answer some questions. We've got through over 20 questions, which is a fantastic effort. Now, as I mentioned before, a recording of the webinar will be on MPower's social media platforms and website later today. Nathan, before I let you go, do you have any final comments to leave with us today?
Look, only that we're very excited about the future of the company, and we think that the milestones that we've reached this week are really just the beginning steps in a journey that will see a rollout in the first phase of 20 projects, and beyond that, we see the opportunity to be a real player and business that can capably deliver all manner of renewable energy projects and look after those projects during their lifetime. So we're pretty excited, and just want to also thank all the support we have from investors, and look forward to talking to everyone about our progress as we check off all the different elements in our strategy.
Fantastic, Nathan. Really appreciate you taking the time to join us. As to everyone who also joined the webinar today, that wraps it up for us here. Thank you, everyone, and have a great day. Thanks for joining us.